Welcome everyone to a new video and welcome to a new mini-series in which I'm going to help you understand the crisis in Europe. In today's update, we'll be diving more into Europe, the energy crisis, double QE from the Bank of England and important data points you should keep an eye on. But before we're going to continue, make sure to hit that like button and subscribe to this YouTube channel if you enjoyed the content. Also, we have partnered with Bybit and can give you 1 full month for free to our premium platform in which we have made 14R last month. All you need to do is sign up to Bybit through our link and you'll be granted access to our platform. All the information is in the description beneath. Finally, if you like what we do, we'll be hosting an exclusive and extensive macroeconomic bootcamp on Monday at 8 p.m. Central European Time. If you want to attend this, make sure to check out the link in the description beneath where you'll be able to sign up through our exclusive session. Enough of intro. What we will be discussing in this week's update, that's what's up next. Today, as stated, we'll be focusing on the energy crisis in Europe, the QE from the Bank of England and important data points to keep an eye on. Europe may in fact become a key indicator for the Fed's policy if the indicators like for example the job market in the US remain strong. But Europe is already on the brink at this point. A few weeks ago we already started with the first episode on the Bank of England, traditional finance and the yields, and this week we continue with the energy market, double QE and the important data points to keep an eye on. Energy prices are down. Will they stay there? Now that we are in the phase where electricity is a scarce commodity, it is good to zoom in on this a bit more so that everyone stays informed about the current situation. We know that by now most European countries' supplies are in good shape and that as long as the winter of 2022 remains mild, there will be virtually no problems. The problem lies with the next few years, especially now that the pipelines have blown up. The electricity situation will change from bad to worse in the coming years. With gas as the main input for electricity and Russia as supplier for 50% of the gas supply in Europe, we see the following trade balance in Europe. As you can see in the picture next to me, we see the countries that are importers and exporters of energy, also known as dependent and independent. The longer this crisis goes on, the sooner electricity nationalism will set in and an every man for himself situation. Countries like Italy, Lithuania, Croatia and Hungary are very dependent on electricity imports, while Sweden, France and Slovenia are typically net exporters. I reckon some will call for solidarity more than others. In a general sense, then, we see a dissection between countries that have electricity and those that are short of it. But the good news is that, as I tell you many times on this channel, the prices associated with peak demand have started to fall very much. We see the megawatt price elevated but weakening further and further from peak. Lately we even saw the discussion in the national news in the Netherlands that prices have been falling. The prices have dropped from 350 euros to 117 euros, which is still 5 to 7 times higher than the levels in 2020, but the effect of the prices to drop for consumers will take some time. For instance, Eneco has been lowering the prices by only 6% for October. It is extremely important to realize that the inflation impressions of recent months have been realized through a complication of multiple supply-demand issues at the same time. That is the peak we are talking about. So now, over time, this runs further down and we see prices falling. It may take a while before it becomes visible again in consumer prices, and since the 8th of September, electricity prices are down roughly 50%. By now, all countries besides Hungary have reached the target of 80% fill levels of natural gas, the main marginal input in electricity production, which is well ahead of time. The only big problem to consider now is that before the crisis we had huge supplies ready to last us for many years and both the pipelines were still operational. It's a long-term problem that we don't have that at this point, structurally due to Russia. However, and this might sound weird, but Russia and no delivery of gas is context and creates noise for investment-based thesis just like a listing of an asset on an exchange or the Bitcoin ETF can be for Bitcoin. In the end, rationality and price action combined with macro data are key for decisions, which means that rationality kicks in, inflation is most likely going to drop heavily. Now, what about gas? Europe remains very dependent on gas. A scenario in which European countries are short on gas and relying on each other's unanimity is very likely. A complete lack of supply from Russia will lead to a combat for the remaining supply. It will be interesting to see how firm the solidarity-based diplomatic ties really are when we are all fighting for the same scarce resource. Overall, the topic seems far-fetched and the impact seems to be taking place already and is most likely behind us, as prices for consumers will be falling in the winter as well. Now, the impact on the markets is extensive at this point, as the Bank of England has announced that they are pivoting as the British pound has been losing a ton of value in the past months to the dollar. What does that actually say for the markets? Well, the Bank of England pivot is a pilot for the rest of the world. And there is a quote which says, "There is nothing so permanent as central banks temporarily stepping in." We have been talking about it for months, and a few weeks ago we saw it happen, and now you see the actual steps in a QE cycle coming forward. Despite it being clear to the entire world that any form of providing liquidity to the economy is a disservice on the local currency, it is often necessary to hold the bigger picture together. The Bank of England is currently a perfect example of the future perspective about the rest of the world. In a world where debt is spiraling out of control, weaknesses will emerge. See the pension funds here? The response was that central banks started printing money so government bonds can be bought and the upward pressure on yields can ease again. But, of course, a single injection of capital is not enough. Short-term downwards pressure has now set up again towards an uptrend, where the following is thus necessary, what I tweeted last week. The Bank of England was not comfortable that the initial intervention and so long maturity bond buying until October 14th was enough to reduce stress, and following a sharp rise in yields Monday the 10th of October, Bank of England announced a widening of its intervention. As you can see in the image next to me, the initial announcement only had a temporary effect, as we are now back into the highs again. You clearly see the response of the yields after these announcements, but will it be enough at this time? That remains to be seen. What is important to realize is that despite the rate hikes, we are now dealing with a dual form of QE. Namely, the buying of government bonds by means of new money, but also the situation that the increase in yield should provide a higher payout to the investors who thus do not get 3.5% interest, but now 4.5% interest. In this world, we are talking about billions. So simply an increase of 1% in interest on 100 billion results in a payout of 1 billion extra. This is a very simplified example, of course, but it's about the principle of what goes on behind the scenes, and double QE at a time of high inflation with forecasts not yet improving. And the GBM2, which is the money supply chart, is not showing any signals of a decrease. Now, why is this so important to understand? That's due to the following two concepts. First of all, it seems likely that the Fed will start to pivot relatively in this quarter as well. However, majority of the people are focused on a pivot on the interest rates. That doesn't need to change unless unemployment is going to rise and inflation falls sharply and economic data is going to be terrible, then it would. But due to that, we could be seeing QT from the Fed and potential buyback procedures from the Fed on government bonds, as such a high interest rate combined with a high debt level will destroy internal markets. Finally, it's also important to understand that the majority has been laughing at the Great Britain for their actions due to this policy. Starting QE and reversing policy all of a sudden, however, if they sustain towards their QT stance and the current weak currency, it would make sense that the tables would turn and that their actual policy of leaving Europe and continuing QT will help them to be a stronger regime and currency against the US dollar, which seemingly looks like it wants to fall over. About that weakening economy, what can we actually find in the data? The data is actually on its way, but will it arrive on time if you want to have like a bullish Bitcoin period? Before we move on to the last week's outlook in the last bit of the video, we take a look back together at the most important data points from 2 weeks ago. These are two, namely ISM and the unemployment rate. In fact, these two values reflect exactly how we are doing economically. First of all, we saw an ISM manufacturing index which continued downward. The number was 50.9, a miss of 1.2 points, and we see that the economy is getting worse. My base case is an ISM of eventually between 40 to 45, a sizable recession, or a bit lower. But one of the arrow points that still stands, also the most important point of the moment, is unemployment. And a positive surprise of an unemployment rate of 3.5% instead of the expected 3.7% or higher reflects an economic situation in which companies have not yet been greatly affected by the economic downturn. As long as the unemployment remains positive, the Fed will not make a move toward a pivot. And we saw a CPI number of 8.2%, which is slightly higher than the expectation of 8.1%. Therefore, it remains logical for the market to react negatively to this and with the statement of sticky inflation. But don't forget that CPI is really extremely behind and therefore also gives a false picture of the current situation. CPI is an indication from 6 to 12 months ago, and that central banks base their policies on data from 6 to 12 months ago can therefore be seen as highly irresponsible, not data-driven, which is what they claim to be. A number of comparisons can be drawn, but they all predict negative CPI around 2024 and thus a continuation of the downwards trend. See here the comparison between the collapse of the G4 central bank balance sheet growth versus CPI, or the decrease in supply chain pressure, mostly responsible for supply-demand imbalance. The picture is and remains otherwise the same. Inflation is a problem of the past and the Fed is over-tightening the markets and basing this on lagging data. All the more important will be the upcoming earnings season, in which we enter the season with very negative expectations. The fact is that earnings do not directly affect crypto, but they do affect the other markets. The question is whether we will end up in a situation where crypto can distance itself, where bad earnings are bad for the S&P, Nasdaq and the economy, but good for crypto. In this video, we talked about the energy crisis and that it is expected to get better in the coming months, but potentially worse in 2023 and 2024. We talked about double QE and that Great Britain is a pilot for the world, as well as what data points are relevant to watch and what I'm watching for next week. As the situation in Europe becomes more and more complicated, I hope that with my videos I can help ensure that you will stay informed about everything that is happening broadly, how it can affect your life and how you can possibly respond to it. That is the actual purpose of this series. Also, the 8 Global Macroeconomic Bootcamp is getting very close. In a 2-hour sessions of myself with Quincy, another team member of 8 Global, we will take you through all the ins and outs of the past few years and why we are in a huge financial mess. If you'd like to attend this, check the description for the link on how to sign up. Thanks for watching, make sure to hit that like button and subscribe button, and don't forget, don't do stupid shit, stay calm and avoid emotional trading. Ciao!